Good afternoon. You're watching Closing Trades on ET Now. I'm Anisha Jain. With me, Sekunj Dalmia as well as Aisha Faridi. And the closing trades for now are telling you that after that sharp consolidation that we saw during the trading session today is now recouped a bit. At least we're off the lowest point of the trading session, managing to hold to that 20,000 mark. However, there's a very sharp profit booking that we witnessed today in the broader markets. Can say that it was coming because of the fact that the small cap and the mid cap indices have run up over 30% this year. So not a complete surprise, but the pace at which it was coming down and the quantum is something that surprises Street a bit, because at one point of time the small cap index was down as much as 4%. Separately, autos have been very volatile on account of that entire news flow and the flip-flop around the 10% additional duty on diesel engines. So we are watching out for that. IT, that's the space that we have been highlighting throughout the week, talking about how there has been large deal wins. TCS is likely to back some fresh orders in US as well, and that entire space is bucking the trend. Having said that, Aisha, it's Reliance, HUL after that weak Q2 commentary, and then NTPC that continue to be the top drag at the index level.
Yes, they do, but kudos to the way L&T has contributed to today's move from the word go. Really, this has been one of the stupendous most performers, inching closer to that 3,000 rupee per share mark. And IT, that's the other pack which is holding out just so smartly. TCS, Infosys, the entire pack is struggling along nicely. But like Anisha said, there is a whole lot of market which is in the red as well. But let's talk about some of the specific newsmakers then in trade. And it's got to be autos, right? And especially the kind of volatility that you saw. Nitin Gadkari saying that they're going to propose a 10% additional GST on diesel engine vehicles and genset, and then the clarification that came by that no such proposal is currently under active consideration by the government, however. But yes, it sure did take its toll on the auto majors, and then they recovered a little bit as well. Having said that, they've been under pressure from the word go today. BEL, an interesting note from Axis Capital, they're targeting mid-teen revenues CAGR over FY25 to 26. They've downgraded the stock to now a reduced target put at 143, and you can feel the heat on BEL, which is down nearly about 7% as we speak right now. Laurus Labs too downgraded sell, target though unchanged at 300 rupees. Kotak says that they've rallied after a washout first quarter and on worst is behind narrative, which is unsustainable according to them. That stock as well, as you can see, is under pressure. L&T though, they've revised the buyback price to higher now to 3,200, and that clearly is adding as a fillip to one of the big nifty heavyweights, which has been a big mover, like I said, from the word go today. But yes, lots has happened actually from the 20,000 mark, Nikunj, that we opened at. That big bout of correction that happened in some of the frenzied sectors, your railway, power, defense names, big cool off coming in, some mild recovery. But that's a telling sign as to where you need to, if you're a near-term player in the market or a short-term player in the market, you need to protect your profit.
See, Aisha, they'd become Humpty Dumpty, and Humpty Dumpty will have a great fall. That does not mean that they cannot recover from the fall. But for me, while we can talk about railways, we can talk about defense, for me I think the overarching theme is what is happening to the penny stocks. The real true indicator of the market mood. So whether it is single digit power stocks, single digit metal stocks, single digit construction names, that's where I think the reversal is very, very sharp. Suzlon's lockdown, I think. You got JP Power, look at JP, you look at Reliance Power, look at Ratan Power. That entire cohort, which in a sense could be called as trader patronized single digit stocks, that's where the reversal, I guess, has happened. Now, the Nifty has not fallen. So the call is, since Nifty has not fallen and Nifty in a sense has lagged this entire market momentum, could there be a situation where markets will fall? I'm talking about mid and small cap stocks, and then they start consolidating and money will start rotating from mid and small cap stocks back into some of the large cap stocks. Or this is day one of what could be called as the excesses in the market getting flushed out, and the excesses may just extend themselves, and this flushing out system may just extend itself for next couple of days. Kunal, I was just looking at the data. Historically, we've seen large cap stocks, they fall, and then mid and small caps, they fall. Right? For the first time it's a rare instance that small and mid cap stocks have fallen and large cap stocks are holding on. Do you think there could be a situation that because large cap stocks have not fallen, the base in mid and small cap stocks will be discovered soon?
Well, yes, seems likely, Coach. And So to add to the point, even in this last leg of the market uptrend, it was the large caps which underperformed, and mid caps which went through the roof for many of the spaces and many of the sectors. Now, I think that's one of the major reasons why the markets are getting into a bit of a corrective mode today. And I'm not talking of the indices specifically, but the market breadth as such. Look at the pockets of sell-off, the likes of even if you look at the top 4-5 names on the futures side, you have the likes of BHEL, PFC, REC, etc., BEL, and these are the ones which had rallied up exceedingly high in the last many weeks as well as over the last many months. So there's bound to be a bit of profit booking, and I don't sense that this could just be a one-day profit booking. I think it could be a process of say another 3, 4, 5 days or another week where these stocks would see some bit of more selling pressure. So in case if these stocks see a bounce, which should be a natural case after such kind of a sell-off, that would be probably taken as an opportunity to try and exit positions. But the other point is also very valid, that large cap stocks should see a lot of stronger buying as well as a decent pattern going forward. So even the likes of ICICI Bank, HDFC Bank, etc., Reliance Industries could be another stock which I believe could probably try and get into a bottom formation zone. ITC has managed to protect its 440 mark, looks attractive. So FMCG, IT, mix of those underperforming stocks from the private sector banks, I think all of these stocks should make a decent comeback.
Have you started going short?
No, I've started to book profits on the mid caps and small caps.
So you're not going short in any of the stocks?
No,
even
no.
defense?
No.
Even power?
See, the stocks in defense, for example, BEL and HL, they're the ones which are in FNO. Most of the other names...
Intraday you can go short. I mean, markets are looking so weak. I mean, tomorrow morning we'll just go and sell railway stocks. You won't do that?
No, I won't do that.
Why?
No, because my sense is that most of the defense names, for example, they are like BEL and HL. They are the two candidates which I keep on advising. They are typically very low beta, and when a low beta stock falls by 7, 8, 10%, you don't have higher risk reward to create fresh shorts. You can't expect these stocks to fall by another 7 or 8%. And if the meat is around just 2 or 3%, I think it's not a lucrative trade to go short.
Nooresh, what is your sense? I mean, it is just one of those bull market corrections that very sharp, very swift, by the time you react, that's going to be over. Because the selling has been quite excruciating, if I may use the word.
So the reason is, if we look at selling is generally much larger in terms of a single day move. Any big downtick is generally more than an uptick. So on 25th August, when Nifty made a bottom around 19,250 odd levels, the Nifty small cap 100 made a bottom around 11,800. And yesterday it came very close to almost 13,000. So that was a 10% move on the small cap index in the last 2-3 weeks. And even today, after the fall, we are closer to 12,500. So we've only retraced half of it. But it's just that if we went 10% over almost 10 to 15 sessions, we've lost 5% from the top in less than one session. So that's the case. But even today, the index is much higher than where it was on 19,250 level. So the whole outperformance in the last 2 weeks of the BSE small cap, the Nifty small cap, has been normalized with the Nifty coming to 20,000. So it's almost a similar 4-5% move on both the indices. So a classical case of fading of over excesses in the system. Now going forward, we look at whether we hold on to that 12,000 mark till the time we are above the 12,000 on the Nifty small cap 100. And we are about 19,600 on the bank Nifty. The bias remains positive. It could be just a shake off of 2-3 sessions.
I mean, look what's happening to names like BHEL, for instance, today. And, that really gives you a sign of that sheer, let's just out our profits, the market has run up too much. BHEL is now down almost 9%. Look what's happening in an REC and a PFC. Both these stocks, significant run up past fortnight. They're down anywhere between about 7 to 7.5% apiece. I can say the same about BEL. Sure, there's a downgrade coming in on that stock today, like I earlier highlighted, but that's also down a good 7% too. Kunal, anywhere between the power cap goods where you would say at least book your profits?
Well, definitely the power finance names, for example, REC, PFC, definitely a good zone to book out profits. Even the smaller cap names like Nikunj was alluding, JP Power, I think Ratan India Power, and many of these stocks which are run exceptionally high, and I think for no reason as such, are also the pockets where I think traders should start booking out profits and get back into that the theme of large cap names. I think that should be the tonality of the markets going forward. We've seen that happening. So even when the index corrected from 19,900 a couple of months back, there was a definite change of tone for the sector performances. Bank Nifty, which was a stronger sector there, started to underperform, and then you had Nifty IT index, etc., started to outperform. So I believe that in this leg of maybe a correction or a consolidation for the index, you would bound to see this sector change coming across, where mid caps and small caps should underperform and large caps should make a strong comeback.
Okay, so that's the take coming in. But Nooresh, what's the view on IT pack? Today, of course, TCS is reacting. There was a news flow that came out that TCS could be one of the likely winners for some of the orders in the US, the ones which are going earlier to the Chinese companies as well. Apart from that, which are the stocks that you like?
So TCS has given a good breakout today. Previous high was around 3550 levels back in February. Again, we topped out around 3530 levels in July. So we are making almost a 2-year high on the stock. And in the previous cycle, TCS was an underperformer in the 2020-21 cycle. So it's taking the lead here. So clearly a leader in the large cap space. Finally, one of the few large cap names which are making 2-year highs. So TCS remains the top pick. Continue to like HCL Tech, which is another stock which has been holding on above the 1200 mark, which was the high for the last 2 years roughly. So TCS, HCL Tech, and then if one is looking out for a bounce back candidate, would be Wipro purely because it has corrected the most. So this would be the three names, and overall IT as a pack has started seeing one by one different stocks making different price actions. We've started seeing large caps also take leadership. So TCS on dips still remains an interesting trade after today's price action.
Thing that we were earlier chatting about in the morning, some of the private banking names are still holding on to their gains. And Nooresh, you flagged up off ICICI Bank, right? If I recall, still holding on to its gain in an otherwise kind of cooling off market. What's the next price target in the very near term?
So ICICI Bank, if we look at the stock price, it topped out at 960 in December 22, then again at 860 in May and July. And for the last almost 2 months, it was doing 960 plus minus 20 points. In the last 2 sessions, it has broken out. The previous highs made in July were closer to 1006, 1010 level. So if it sustains 1010, it could be a fresh breakout, a momentum trade where it could go towards 1050, 1100. So ICICI Bank looks interesting. Axis Bank hit a new all-time high yesterday. Today also is holding on. IndusInd Bank above 1430. So the whole private bank looks interesting. Apart from that HDFC Bank and Kotak Bank, which are recoveries from the bottom, but the other private banks like Indus, Axis, ICICI are actually knocking at 52-week highs. So they look very promising.
Let's take a break. But you got banks which are holding on, IT which is holding on. Now, who's buying? I don't think DIs are going to be buying TCS or ICICI Bank on a day when markets have fallen. It clearly means that somewhere from the FI front, either money is rotating or money is genuinely coming back. Typical market action, if there is excruciating fall in small and mid cap stocks, and if the leverage concerns are not there, if the global concerns are not there, markets will rotate back to normally to defensives, but right now I think it's going back to banks. You know, I think that if you ask me what is the new defensive banks, yeah, I mean, just think about it. I mean, what is defensives? Defensives is something where you can predict earnings visibility. Why did you call IT and pharma defensives? Because, see, defensive, they were called as IT and pharma and FMC defensive because consumer story in India is intact, global story in IT is intact, and the pharma outsourcing story, at least a couple of years ago, was always intact. You were unable to predict the earnings for metals, infrastructure, autos, and to some extent banks. Now, where can you predict the earnings? Banks. Can you predict the earnings in IT? You can't. Can you predict the earnings in pharma? You can't. Can you predict the earnings in infrastructure? To some degree, yes. But infrastructure is a debt. So I will not call it defensives. But where are you confident of trends in terms of momentum? Where are you confident in terms of balance sheet expansion? Where are you confident of low NPA and high retail growth? Banks. So in my book now, banks are the new defensives. It's a new one. But yeah, I think that is the one could be at play. Let's take a break. When we come back, we'll take this theory forward. Are banks the new defensive?
Back with closing trades right here in ET Now. Still trying to latch on to that 20,000 mark, at least for the Nifty futures. We are staying put at that level. That, of course, is the Nifty Bank. That's also covered its losses from earlier today. But yeah, the Nifty futures are still holding on to 20,000 and we are back at that mark for Nifty Spot as well. Let's see whether for a second consecutive day we're able to close above that mark or not, given the kind of cool off that you had in the first half of today's trading session and the recovery then thereof. While TCS, L&T, ITC, Infi continue continue to support the market. BHEL, REC, PFC, BEL, NCC, GMR Infra. These extremely exuberant mid and small caps are the ones which are seeing a massive bout of correction. But let's figure out what else lies ahead. Rakshit Ranjan of Marcellus Investment Managers joins us on the show right now with his take on the markets. Rakshit, hi, afternoon. Good to have you on ET Now today. Rakshit, your take on the market right now. Protect capital, book some profits, at least when it comes to mid and small caps, or do you think this is just a one-off aberration that we are seeing?
Good afternoon. First of all, thanks for having me on your show. Now, the answer to your question, I think, is also it needs to be contextualized in terms of the exposure that you already have. If you've got exposure in areas where there has been a massive re-rating upwards of multiples, or the earnings had a tailwind to itself over the last 1 to 2 years, which perhaps is a tailwind from the external environment. So you were in a commodity upcycle as a commodity producer, or you were let's say a highly leveraged maybe a bank with external environment becoming more and more benign in terms of NPAs, etc. If those are the exposures of the investor, then I think it's better to book profits, certainly. But if your exposure has been to sectors where fundamentals have actually run significantly ahead of share prices, so for instance, you were talking about the kind of stocks that are doing well on a day like today, you would actually invest more and more there, because there are segments of the stock market which in the last couple of years haven't progressed in share prices with the fundamentals. Those are massive opportunities to make money. So I won't say the market is overvalued as a pack. There are segments that you should not have exposure to, in my view, and there are certainly segments that deserve more and more exposure at this stage, given what has happened in the last 2 years.
So can you be slightly more specific here? I mean, is there a list you can share with us, what to avoid and what to buy, where to reduce, where to add?
Sure. So for instance, talking about the lenders, I think private sector banks versus public sector, right? That's a massive, I would say, difference between how in the last 2 years an HDFC Bank or Kotak, and by the way, as a disclaimer, these two banks are part of our portfolios, our clients' portfolios, our families' portfolios. So an HDFC Bank or a Kotak or a Bajaj Finance compared to some of the other banks which have had a great rally in the last couple of years, but not for reasons that can be sustained for the next 5 to 10 years. Talk about, say, some of the consumer discretionary companies, some of the retail plays where there was a lot of noise in the last couple of years because of either COVID-related impact or input cost rising, and hence last 12, 18 months, margins were depressed, but those are not sustainable factors. Margins will recover or have already recovered, etc. So, yeah, I mean, so for instance, the likes of say, in our portfolio, Page Industries, Asian Paints, an HDFC Bank, a Bajaj Finance, etc. Those are some of the stocks we have exposures to.
The raging debate in the market is whether the mid caps are expensive or not. Yesterday, of course, we had, Sanjeev Prasad Kotak Institutional Equities dropping their mid cap recommendations, saying they're running out of options. What are you doing with your little champ portfolio? Are you also running out of options, or which are the spaces where you are adding there? Because I remember that chemicals, financials, industrials, these were your overweight sectors there.
Yes, so we are making changes because when you're in the small and mid cap, then I guess the frequency with which you need to sort of change with the changing dynamics of the companies and the businesses, the industries in which they operate is also a little higher frequency. So yes, for instance, in some of our companies, we have some of our smaller mid cap portfolios. More recently, we have added Trent as a stock, the West Side Zudio retailer. We have added one hospital retail, hospital chain to our portfolio. So those are some of the additions, for instance, and we have trimmed or exited from some of those sectors that you just mentioned that we had significantly higher exposure to previously. But yeah, those are some of the pockets as examples.
Understand trend. I mean, I was looking at numbers. It's at what, 120 times 1 year forward. History tells us that when you buy stocks above 50, 60 times, you don't make money. This is 120 times.
Right. So that's very interesting. Two ways to understand that. One is, if you remember, 2 years ago, approximately 2 years ago, Titan was at 2,000 rupees a share when it was 250 times trailing, and maybe about 100, 150 times 1 year forward. Since then, it is up 50%, and PE multiple has actually derated, right? Because the earnings was not a normalized earning. So when you look at a business like Trent, first and foremost, Ind AS, the accounting standard 116, has ensured that if a retailer expands store count aggressively, then rental bookings, which are more linear on a cash outflow basis, on the P&L, they need to be recognized upfronted. So your costs are high as a non-cash item under Ind AS 116 if a retailer expands store count and takes on more leases at an accelerated pace. Where just for that, suddenly you realize that there's a good 30 to 40% drop in the PE multiple suddenly when you normalize for cash element or go pre-Ind AS and normalize it for that aberration. It's an aberration. It's an accounting aberration. Secondly, the next big thing is this is a retailer which is growing profits, revenues at a rate of 35, 40, 45%, depending on which business model of this retailer you're talking about and whether revenue or profit, etc. It's a high rate of growth. So the rate at which this PE multiple falls from 1 year trailing to 1 year forward to 2 year forward is a very rapid rate. And as a result, a DCF captures the true value which a PE multiple doesn't for such a business where near-term growth rate is far more accelerated variant of a normal business of this size. And there's also one other piece worth bearing in mind. There's an optionality here on Star Bazaar, the retail format which till last year had been experimenting, and by means of doing those experiments, there were some losses. If you believe that those losses will be reducing significantly because the experiments are approaching a steady state proof of the concept, successful retail format, which we do, that's what we believe, then suddenly the normalized earnings, it goes up. So what you're talking about as a PE multiple is on the face of it. But the moment you normalize it for how the P&L is going to look like, adjusted for aberrations, you realize that the real PE multiple is actually much lower than that.
Okay, point taken. You were also talking about some of the hospital chain companies that you've added. What's the name there, and what's the view on IT? Are you incrementally getting positive there, adding on to your positions?
IT, yes. So, for instance, TCS is in our portfolio of large cap consistent compounders, and then we have LTTS, Tata Elxsi in some of our other portfolios. And again, disclaimer: clients, families, and ourselves, we have exposure to these stocks. So these are some of the names on which we have increased our positions over the last 12 months incrementally, because the concern of the market was US going through recession and hence let's exit IT, etc. That gave us some opportunity, some pockets to increase exposures in some of these areas, which we've done wherever we see the resilience being there to the businesses. The hospital chain, actually, I'll have to check if we've disclosed the name or not yet. But it's a sort of mid-sized South India-based hospital retailer, and these are businesses which are coming of age in the sense that the demand side which is, let's say, the patients walking into a hospital to get treated, is moving from mom and pop setups or unorganized setups to more formal, experience, service-oriented setups, which at times even end up creating a brand recall, etc., etc. But more than that, you get services that mom and pop standalone labs don't, standalone setups of smaller hospitals or clinics or nursing homes don't provide. And hence, provided a hospital chain can actually generate high ROCEs, run the business efficiently, scale it up as a large format retailer, it's a very attractive investment opportunity area.
So on that note, we let you go. Appreciate you making time and speaking with DT now today. But time now to go across to our technical experts and get the closing trades from them as well. Nooresh, you go first.
So would stick to Axis Bank. That's a stock which has been trying to hold on to that 1,000 mark. Out here, fresh 52-week high, fresh all-time high. So could see follow-up going forward.
That's a take coming in. Axis Bank is one of the stocks that Nooresh likes. No surprise there. But what about you, Kunal?
So IT stocks from the defensive pack look attractive, and Infosys is something which I think at 1500, 1490 mark looks attractive for more of a BTST trade from current levels, expecting that if the market gets into a further corrective mode, the IT stocks could probably rise up by at least another couple of percentage points on the next couple of days.
Okay, on that note, we're going to take a very quick break. Come right back. We'll continue tracking the last half an hour of trade this afternoon.